Hi guys, welcome to Stock Brains. My name is Ayush and today in this video we are going to talk about bar chart patterns, which are also known as long-term patterns in technical analysis. So these kind of pattern includes head and shoulder pattern, double top, double bottom, flag and pennant patterns, and so on. So these patterns are used by technical analysts a lot in today's world, and you may find that in a publishing newspaper and in many places you will find that people are using these bar chart patterns or these long-term patterns to trade in the stock market or in any other financial market. So these bar chart patterns are mainly used in stocks, but it can be used in other instruments like commodities, forex, and cryptocurrencies as well. So bar charts are something which are used very widely by technical analysts over the world. So we will understand this thing in very much detail in this video, and we will understand what are bar chart patterns, how these patterns form in technical analysis, how to trade them, where to keep stop loss, where to take our targets, how these patterns work, and how can we take entry, how can we book our profits, and so on. So we will discuss all these patterns in a very practical way, and we will understand what things can come in our CMT exam. So we will understand things from that point of view as well. So let's begin. So if you are new here, then I would recommend you to watch this playlist, and here I have uploaded CMT level 1 chapter wise videos, so you will find everything related to CMT level 1 exams over there. So if you watch these videos, then your understanding about every topic would increase, and I'll try to cover everything which can come in your CMT exam, and this thing will get updated very frequently as per the CMT exam. So the syllabus is going to be always relevant, and these videos are going to be always relevant for you. So if you are new here, then I would recommend you to watch this CMT level 1 chapter wise videos. So I have arranged these videos chapter wise, so you can cover all the videos, all the syllabus that are there in our CMT level 1 exam, and I'll update these videos very frequently. So this syllabus is going to be relevant all the time. So I would highly recommend you to watch these videos. If you are someone who wants to give these CMT exams, then I would say that these videos are gonna help you. So check that out and bookmark this playlist if you want to watch all the videos. Now let's come back to our topic. So first understand what is a pattern. So a pattern is simply a configuration of price action that is bounded above and below by some form of either a line or a curve. So before understanding bar chart patterns, let's understand what is a pattern. So pattern is simply a configuration of price. That means it is a collection of price, I would say. It is a collection of price action, right, that is bounded above and below by some form of line or a curve, and this line can be a support line or resistance line. Let me show you how these patterns are formed. So this is one very famous pattern of technical analysis. It does not come under bar charts pattern, but it is a pattern. So I thought let's tell you that. So it is a channel, as we all know. So this line is our resistance line, which is above, and this line which is there below is known as support line. Both of these lines are trend line and these lines are parallel, and between these lines there is some price action. Bars are going up, going down, going up, going down, and that's how that pattern has been formed. So that's how we find patterns in technical analysis, and we define these patterns by drawing these lines. It can be trend line, it can be support line, it can be resistance line, it can be anything. Now let's talk about some of the common pattern characteristics. So every pattern which we find in technical analysis has some uniqueness, and some patterns have this common things, and we are going to discuss that commonality which exists in all the patterns. So all the patterns are having entry and exit. All the patterns are fractal in nature, and on the patterns which occurs have a pullback and throwback sometimes, and these patterns can fail sometimes. So these are some of the common characteristics that you will find in all the patterns. Now we will discuss these points one by one. Now when I say entry and exit, so let's understand this word entry and exit from our chart point of view. So whenever any pattern forms, before that the prices are moving just randomly here and there, and then the prices comes under this channel, right? So this line which is there below is our support line, and this line which is above is our resistance line. I hope this thing is clear to you. So these two lines are there, and this pattern formed in between these lines. So the prices came first, right? And when the price came, we said entry has happened, right? And after the pattern formed, then the price exited, somewhere over there. So exit happened, right? So every pattern which occurs in technical analysis has an entry and an exit. I hope this thing is clear to you. Now let's move on to our second characteristic, that is fractal. So all the bar chart patterns which you see in technical analysis, all the bar chart patterns are fractal in nature. Now what do I mean by fractal? I have covered this thing in previous videos as well, but if you don't know what is fractal, then let me tell you. Now this pattern which you saw just over there, it's a pattern which can form in 1 day charting as well, and it can occur in 5 minute charts as well. You can find that in 1 hour chart as well. So this pattern is same, right? You can find it in 5 minute as well, you can find it in 1 hour as well, you can find that pattern in 1 month chart as well. So this pattern is kind of universal, and it can occur in all the time frames. That's why we say that this pattern is fractal. It is not limited to any time frame. And this is why we say that this is fractal, right? Now let's talk about pullback and throwback. So pullback occurs whenever prices breaks out downward trend, right? So pullback occurs in downward trend and throwbacks occur in upward trend. I hope this thing is clear to you. I have told this thing in previous videos, but if you don't know, then I'll tell you that thing again. So here you can see that the trend was down, right? The previous trend was down. I hope this thing is visible to you. Now the previous trend was down and the breakout happened, right? So after the breakout happened, prices started going down, but it took a correction, came back to this point, which is a very important resistance point for them. And whenever the price breaks out any level and comes back to that breakout level, then we say that okay, the pullback has happened. I hope this is clear to you. Then after the pullback happens, the downtrend continues. So that's how the pullback looks like. It is very simple. And throwback happens in uptrend. So here the previous trend was up, right? So as we know, throwback happens in uptrend. So this was a major level which got broken. It was a resistance which got broken, right? So after the resistance got broken, it became support, right? So after that, this level got broke, the prices came down, took support from this level, and then it went up and continued its uptrend. So that's where our throwback happened. This whole scenario is known as throwback. Whenever a price breaks out its major breakout level and then comes back to test that and take support from that, then we say that it's a throwback. Now let's move on to another characteristic, which is failure. So failure can happen in almost every pattern which exists in technical analysis. So no pattern exists which cannot have failure. All the patterns can fail in any of the formations. Some patterns fail more than others. So some are more accurate, some are less accurate, and we will have to identify that as an analyst, which pattern is false, which pattern is not false and true. So patterns can give you indication of trend change, but it is not a guarantee, right? It is not a guarantee, and all the patterns can fail. Let me give you an example of this. Now let me erase all the ink, and you can see that this was a major resistance, right? This was a major resistance. So price broke up and then suddenly started going down. So ideally it should take support from this level, but what if the prices went down? Then this pattern would have got failed and no throwback would have occurred, right? So this throwback thing can also fail, and likewise all the patterns in technical analysis can fail. I hope this is clear to you. Nothing is certainty, it is all probability. The prices could have come down as well. In this case it went up, but it could have come down as well. So that's why we say all the patterns can fail in technical analysis. Now let's move on to traps. So trap is also a kind of failure, but there is a difference between a failure and a trap. So trap has been made deliberately by institutional investors or by smart money or by operators. You can name them anything, but it is the smart money which knows more than we do, and they deliberately make these situation where retail investors or retail traders are trapped, right? Like in our house, we set up traps for some mouse so that these mouse can get captured in our box. So we also set up some traps in our house, and these traps also exist in the market. Now let's look at how these traps are formed in our market. So here you can see one example of trap. So you can see that this level was a resistance level, right? This level was acting as resistance. Why? Because this was a point where prices took resistance. This was another point where prices took resistance. So it was an established resistance level, I would say. Then the prices suddenly closed above this resistance point, and one could have said that, okay, see the prices closed above resistance, now it is likely to go up, and retail investors would have bought at this level. But what happened? The prices went down. So this is known as bull trap, and this thing can happen in downtrend as well. Whenever it happens in downtrend, we say it is a bear trap. I hope this is clear to you. So that's how trap works in the market, and it is said that these traps are made by institutional money, smart money, or operators, and it is not normal nature of the market. I hope this is clear to you, and this is the difference between trap and failure, right? Now let's talk about market structure and pattern recognition. So as we all know that the market has changed very much. It is very different from the past. And when technical analysis started in late 1600, and when this candlestick was formed by Mona Lisa Huma, then after that the technical analysis has taken many ups and downs, and it has developed a lot. People have developed a lot of technique. Before, these long-term patterns were not there, but now they exist, right? Now they exist because people have identified these patterns, and apart from these patterns, a lot of things have evolved in the market since then. So now we live in a very technological advanced world where every information is available at free of cost. I would say every information is available free of cost to us. We can read the charts of all the things, and these patterns are quite easy to recognize if we compare it to the past, because in the past people had to do a lot of hard work to recognize the charts and to plot the charts on a piece of paper, and then they had to identify all these patterns. But now nothing such exists. We can identify these patterns very easily. So the patterns have changed since then, and some of the patterns which were famous and which used to work before now doesn't work anymore. So once a pattern is widely recognized, its effectiveness diminishes. Once everybody knows that this pattern works, then its effectiveness starts diminishing, and this is happening in all the chart patterns. So we have to adapt ourselves as a technical analyst in this market. Now let's talk about bar charts and pattern. Now bar charts patterns are formed by combining support and resistance zone and trend lines. So bar chart patterns can be formed by combining support. You can take resistance as well, and sometimes people use trend lines to form these bar chart patterns. Now we are going to discuss bar chart patterns. Before, we discussed only and only patterns. So patterns can be of any type, but when we talk about bar charts patterns, then we are talking about those patterns which are formed by our candlesticks or our bars which exist in the market, which is a western tool which looks like this. A bar looks like this. So these patterns are a combination of these bars, right? And we will identify some of the patterns which are very famous and which are bar chart patterns. And traditionally these patterns are divided into two categories. The first one is continuation and the second one is reversal. Whenever continuation happen, it means that the pattern is saying us that the prior trend has continued. Let's say before the pattern formed, the previous trend was up. When the pattern formed, the trend was sideways, right? But after the breakout happened, the trend started again going up. So whenever the trend continues itself, we say it's a continuation pattern, and whenever the trend reverses after this bar chart pattern, then we say that it's a reversal pattern. And I would say that these bar chart patterns are very subjective in nature. It is not very objective. So you need an eye to understand and to analyze all these patterns. I hope this thing is clear to you, and you will have to practice a lot to understand these patterns very practically. Now let's talk about some of the classical bar chart patterns which exist in our market. So there is double top and double bottom, there is rectangle pattern, there is triple top, triple bottom, and there are standard triangles. So this is a major classification. This is a major classification, but within these types, a lot of subtypes are there. So we will discuss all of these things one by one. Now first let's talk about double top and double bottom. So it is one of the most simplest pattern in our classical bar chart patterns, and I would say it is one of the least reliable signal, because you will find this pattern very much oftenly in the market, and that is why it is the least profitable pattern of all. Edwards and Maggie, which researched a lot about these patterns, and you will find their names almost everywhere. Whenever we talk about long-term bar chart patterns, you will find these two names a lot, because they have written books, they have done a lot of research in this topic. So if you want to learn more about their strategies, how they analyze double top, double bottom, flag and pan pattern, and so on, if you want to know more about bar chart patterns, then I would highly recommend you to read their book if you want to understand this thing completely. Now double top consists of only 3 reversal points, right? Two peaks which are separated by a trough. So now let's understand this thing by an example. Now this is an example of double top. You can see that here a resistance line is there, and here you can see that there are two resistance points. This is first one, this is second one, right? So here the prices face resistance at this level, and here you can see that it is a trough, right? It is a trough. So this support line in this case is known as neckline, because it is joining this trough, right? If you want to take entry while trading this double top, then what you can do is that whenever the breakout happens, whenever the prices breaks out this level, then you can sell that, right? But if you want to wait, if you want a good risk to reward, then you can sell at pullback as well. I hope this is clear to you. Now let's look at some real example, live example. So this company name is Gillette Corporation, which is a US company, and here you can see that the prices are making resistance, right? The prices are making resistance, and the prices made a double top. You can see that the prices made a double top, and here the breakout happened, right? And it was an opportunity to sell. And this red line which is over there, this red line is known as neckline in this case, right? I hope this thing is clear to you. Now let's move on to double bottom. So that's how the double bottom looks like. So double bottom will have two bottom, right? First one is this one, and this one is second bottom. And this line which is above over there, and it is a peak in this case, is known as neckline, because it is joining, it is telling us that where this pattern will get completed. So this neckline, if gets broken, is going to tell you that okay, the pattern has formed, and now you can initiate a buy position or a sell position as the case goes. So this was an opportunity to buy, right? And you will buy or sell only when the breakout happens, only after the breakout happens. You wouldn't buy and sell while the formation is happening. You will buy or sell only after the breakout happens. I hope this thing is clear to you. Now let's talk about rectangles, which are also known as trading range or a box. So how does a trading range or a box looks like? Let's see that. So a box looks like this. So it is a box where you can see that the prices are within the box, and we also call it as rectangle, right? So here this is support line, this line is support, and the line which is above is resistance. And when the price breaks out this level, then we can make our buy entry, or we can make our buy entry at this throwback, right? At this throwback as well we could have bought. So that's how we can analyze these rectangle patterns, and that's how we can trade these rectangle patterns. Now let's look at some live example of rectangle pattern. You can see here that the prices are within this support line and the resistance line, and here you can see that in this example the prices broke down. Now let's talk about triple top and triple bottom. So triple top is just a rectangle where the number of touches gets increases. In double top there was two top levels, so the double top would look like this. It would look like this. Here the price was touched this line only two times, only and only two times, but in triple top or in triple bottom the prices touch a level three times, right? So whenever a particular level gets touched more than two times, three times or four times, we say that it's a triple top. I hope this is clear to you. Now this thing is less common in nature and more profitable than double top or double bottom. Let's look at this chart, how this triple top forms. So this is one hypothetical example of how the triple top would form. Here you can see that there are three resistance point, right? And it is an example of triple top. So whenever the market makes a top, then it goes down, right? So it is a bearish pattern, right? And like any other pattern, the entry would happen only and only after the breakout, and alternatively you can take another entry at pullback, right? So there are two opportunity, one is at breakout and the another one is at pullback. Now let's look at one live example of a triple top. So this is Adobe system stock which is listed in Nasdaq, and here you can see that the prices made this top. This is second top and this is third top. So after the triple top happened, what happened then? Then the market came down, then it again came up, then it broke out this level, right? This neckline was broken. So after the neckline was broken, after the breakout happened, then there was any entry, right? So this was an entry. Here we could have sold. So that's how you can trade triple tops, and you could have taken your stop loss somewhere over there, some at this level you could have taken your stop loss. Now let's look at triple bottom example. So here you can see that this level is support line, right? And you can see that the prices touched this level once, twice and thrice, and after the triple bottom happened, then what happened? The prices broke out this level and it was an opportunity to buy, right? And after the throwback happened, another opportunity to buy came in, right? So that's how triple bottom looks like, and I hope these patterns are clear to you. Now let's talk about standard triangle patterns. So basically there are three types of standard triangle patterns. The first one is descending triangle, second one is ascending triangle, and the third one is symmetrical triangle. So these triangle patterns are different from other bar chart patterns, and these patterns are not bounded by any parallel line, right? So in double top, what happens is that there is a one resistance line, there is one support line, and the prices are within that, and it breaks out some level, right? But these lines are parallel in nature. That means it would never meet. This resistance line and the support line is never going to meet. But in triangle, things are different. In triangle, what happens is that one line goes like this, another line goes like this, so a intersection happens. So that's how the pattern forms, and it breaks out above or below, but intersection of these two lines, resistance line and support line, happens. So this is one special thing about triangle, and it helps us to calculate our target and to keep our stop loss and things like that. Now let's talk about apex and base. But before talking about apex and base in triangles, let's look at one practical pattern of triangle. So this is how a triangle looks like. So this is an example of ascending triangle. Why are we saying that it is an ascending triangle? Because you can see that this line is going up, right? This line is going up, and in ascending manner, what happens is that the prices goes from below to above, right? Like the smallest number comes first, then bigger number comes. Like if I want to put some numbering in ascending order, then it would happen like this: 1 2 3 4. So the numbering or the prices would increase eventually. So whenever this thing happens, whenever we make ascending triangle pattern, then we are making a pattern where the prices are increasing. That is why we are saying that it is an ascending triangle. And you can see that this price line, this support line, is also going up, and that is why we are saying that it is an ascending triangle. I hope this is clear to you. Now let's talk about apex and base. So what is apex or what is cradle? Let's talk about that. So it is a point where two lines extend and cross each other. This thing is very important, where these two lines cross over each other, and this level is known as apex or cradle. So In this example, you can see that here these two lines crossed each other, and that is why we said it is an apex, right? This is why we said it is an apex. I hope this is clear to you. Now let's talk about base. So base is the difference between first high reversal point and the first low reversal point within the triangle, and that level is known as base. So here the base would be this. The first high point was this, and if you measure the height, we would say that this is a base. This is a base. I hope this is clear to you. Now why we use this base and where to use this base, I'll tell you very shortly. But before that, let me tell you another thing. So this apex is also known as cradle, as we all know, and base we will have to calculate every time. And why we use base, let's discuss that. So let's say here the breakout happened, right? At this point the breakout happened. Now what target should I take? Like if my position goes in profit, then what should be my target? Now to define my target, I'll have to use the base height. So I will use this base height and put it over there, and whatever height this base is having, that height is going to be my target, and I would measure this from this breakout point. So that's how I can use base to take my profit targets. I hope this thing is clear to you, and I can keep my stop loss somewhere below this breakout point or at this red support point. I hope this thing is clear to you. Now let's talk about another example of where you can we use base and cradle. Now here you can see that we have a chart of AUD USD. So it is Australian dollar versus US dollar, and here you can see that the prices also again made a symmetrical triangle. So this is an example of symmetrical triangle because you can see that this line and this line, both of the lines are contracting simultaneously, and this is why we say that it is symmetrical, because both the lines are in symmetry. So here you can see that same thing is happening. So we measured our base. First of all, we measured our base, and when the breakout happened, we took our entry, right? And to measure our target, we used this base height to take our profit in the triangle pattern. I hope this thing is clear to you. Now let's talk about descending triangle. So descending triangle looks like this. So if I were to arrange a series of numbers in descending order, then I would do like that. I would write the highest number at the top, then it would go like this: 5, 4, 3, 2, 1. So this is our descending order, right? So the prices comes down, right? Over the period of time, the prices comes down in descending triangle. So here you can see that the prices made a resistance, and this line is going down, right? Not up. That's why we say that it is a descending triangle. Sometimes what happens is that people get confused between this ascending triangle and descending triangle, and whenever somebody asks you that, okay, tell me whether it is a ascending triangle or a descending triangle, then you just need to check this trend line, whether it is going up or down. If it is going down, then it is a descending triangle. If the trend line is going up, then it is ascending triangle. I hope this thing is clear to you. Now at breakout, we could have taken our entry, and when the pullback happened, there was another chance to take an entry of sell, right? So in descending triangle, we could have taken sell position in this example, but this descending triangle can also give you breakout on the upward side. It does not have to give you breakout on the lower side only. It can give you breakout on the upper side. So this triangle pattern can give you breakout in upward direction and in downward direction. Now let's talk about ascending triangle. So ascending triangle is completely opposite from descending triangle. So in ascending triangle, the trend line goes like this, and there is one resistance line, right? So it looks like this. Now let's look at this thing in our live example. So this is one hypothetical example where you can see that this line is going up, and this line is going up, and this line is going up, and in ascending order it is going up. So we are saying that, okay, this is an ascending triangle, but here the breakout happened on the downward side. So here we could have sold on the breakout, and after the pullback came, then also we could have sold. So that's how we can trade ascending triangle. Now let's talk about symmetrical triangle. Let's look at one live example of symmetrical triangle. So here you can see that the prices are within this triangle, but this triangle is different from ascending and descending triangle, because here you can see that both the lines are either going up or going down. So both the lines are contracting, right? That is why we are saying that it is in symmetry. This line is also contracting, this line is also contracting, and that's why we say it is a symmetrical triangle pattern. Now you can see that the prices are within this, and once the breakout happens, we can initiate our position. We can initiate our position after the breakout happens. Now some people ask me, while the pattern is in formation, like this pattern is in formation, and here at this level, should I buy? Should I buy at this level, or at this level should I buy? So my answer to these questions is no. Why? Because the pattern isn't formation. Now the breakout could have happened on the downside as well. It happened on the upside. So whenever any pattern forms, so it is a kind of uncertainty situation where the breakout can happen anywhere. In any direction the breakout can happen. So we cannot anticipate that. So whenever the pattern is in formation, like whenever this price are forming, then we should wait. We should not act, we should not buy or sell. Only and only after the breakout happens we should act. I hope this thing is clear to you. Now let's talk about broadening pattern, which is another pattern in technical analysis which people use very rarely. Now how does this pattern look like? Let's look at this. So whatever patterns we saw in triangles, these all patterns were contracting in nature. So this was our descending triangle, contracting in nature, right? Because this line was going down. And this was an example of ascending triangle where the prices were also again contracting, right? But in broadening pattern, both the lines get broadened over time. So it does not contract, it just broadens out. So this is why we say that it is a broadening pattern. I hope this thing is clear to you. And this pattern is not used very much oftenly, and it is one of the most least useful patterns for a number of reasons, because it is very rare. It is very rare in the market. You will not find it very easily. It is very difficult to identify as well. And even if you find it, you will have to be very cautious, because it is very difficult to profit from, because the boundary trend lines are getting widened. So you will have to keep a bigger stop loss, and you don't know when the breakout would happen. And even if the breakout happened, then there is a high probability that the prices would come down, and the chances of failure is very high. I would say that you should not use this, but it is mentioned in our book, so that's why I told you this pattern. Now let's talk about diamond top, which is very less frequent, and it is very rare but very profitable. And I would say that it is one of the most profitable bar chart patterns. So it consists of a broadening pattern as well as a symmetrical triangle. So it is a combination of both. Now why does it happen? Let's see. So here you can see that on the left side, on this left side, you can see that the broadening pattern was occurring, right? And on the right side you can see that there is symmetrical triangle, right? I hope this thing is clear to you. If we take this green line as a partition, then on the left side you can see that a broadening pattern is happening, and on the right side a symmetrical triangle is forming. So how to deal with this? Now let's understand this. So whenever any breakout happens, you take a short entry over there, right? And you can take another short entry on a pullback if any pullback happens. Now where to keep target, what to keep it in a target? So to analyze the target, you will have to take this level. So this is our base, right? So this is our baseline. So you will have to take this baseline, put it over there, measure it, and your target will be defined by this base, right? This baseline would define your target. I hope this thing is clear to you. And this pattern is very profitable, but it is very rare. So once you find it, I would advise you to trade on that. Now let's talk about wedges. So wedge is also a pattern where both the trend lines are heading in the same direction. So it is one of the triangular patterns, but here what happens is that both the trend lines are in the same direction. So if the wedge happens, then both the trend lines are on the upside, or in the downward wedge, both the lines are on the downside. So here you can see one live example of rising wedge. It is although an hypothetical example, but you will understand the structure of a bar chart pattern through this. So here you can see that both of these lines were going up, right? Both of these lines were going up, and when the breakout happened, this was our sell entry, and on the pullback as well, we could have taken sell entry. So a rising wedge can give you breakout on the downside, and on the upside as well, it can give you breakout. Now I think we have cleared our rising wedge. Now let's talk about declining wedge. So declining wedge has lines which are heading downwards. So here you can see that the trend was down, right? Here the trend was down, and you can see that this time we got a breakout on the upside. Although the breakout could have happened on the downside as well, but here we got it on the upside. So this was a breakout, and here we could have bought, right? And on the throwback as well, we could have bought, but we don't get throwback all the times in bar chart patterns. So it is advisable that you buy on breakout. So now let's look at one live example of this declining wedge. Let me show you this example on trading view. So here you can see that this is Bajaj Finance 1-day chart, and here you can see that the previous trend was down, right? So we will have to look at the previous trend as well whenever we trade this declining wedge. So here you can see that the prices were consolidating, and both the trend lines were heading on the downside, and here you can see that the breakout happened. So this was the time where you should have bought, right? So this was our buy time, right, at this green candle, and we could have taken our stop loss somewhere over there below this green candle, or either we could have taken the stop loss below this green candle as well. So there are many methods to take entry and to take exit. I hope this declining wedge is clear to you. Now let's move back to our slides. Now let's move to head and shoulder. So head and shoulder is one of the most famous pattern in technical analysis. Profitability is very high in this pattern, and it is very famous as well. And the profitability is very high even though the pattern is very famous. So as I told you previously, once the pattern gets very famous, then the profitability declines. But this thing has not happened with this pattern. Its profitability has remained over the past few years, and the profitability is very high because it's a complex pattern, very subjective to analyze. You can't analyze it very easily, so you need practice. You need a lot of practice to analyze head and shoulder patterns properly. So head and shoulder patterns are seen mostly at top, but you can find it at bottom as well. So it shows you that the prices are in a consolidation. Now let's look at how this head and shoulder pattern is formed. So here you can see that here the entry of, the entry of price action happened, and here the prices started happening. Here the prices made a left shoulder, and above that the prices made a head, right? So this price point was above than this left shoulder. So this head is going to be higher than our left shoulder and our right shoulder. So in our body, as you know that there is a head, there are two shoulders, right? People have used this analogy to name this pattern as head and shoulder. So after the right shoulder occurs, then a breakout happens, and when the breakout happens, you will have to take your entry, right? You can take your entry at a breakout, or you can wait for pullback for a better risk to reward entry. But where to keep our targets? Let's understand this. So we will have to make a vertical line from the head to this neckline, right? And this is also known as base. So we will have to take this baseline, and this baseline is going to be our target. So we will measure the height of this baseline, which is over there vertically, and we will put it over there, right? We will put it just below the breakout, and we will take the target as per the base height. So I hope this thing is clear to you. Now let's look at one live example. So here you can see that this was left shoulder, then a head gets formed, then the right shoulder gets formed. So the pattern looked like this. When the breakout happened, you got an opportunity to sell, right? So this was an opportunity to sell, and our target would have been this. So first we will have to measure this base. and once we measure this base, then we can take our target as this base height, right? So we will have to form this base somewhere over there, and our target would have been this point. I hope this thing is clear to you. Now let's talk about flag and pennants. And these flags and pennants are also known as half mast pattern, and this thing can come in your CMT exam as well. So these patterns are kind of very rapid. They are having very reliable outcomes as well, because in all the patterns, like in head and shoulder, these patterns takes around 3 to 4 months to form in long term charts. And when we talk about other patterns like triangle patterns, then these patterns also take around 2 months, 3 months, etc. when we talk about long term charts. But these flag and pennant patterns happens very early on. Within 1 month you will find that the whole flag pattern has happened. These patterns are quite quick to occur, so that's why we need very good command over flag and pennant pattern. Where to enter, we will have to identify that level pinpoint, because you don't get much chances in flag pennant patterns. So here is the diagram of flag and pennant hypothetical example. So here you can see that before the flag got formed, this is flag, right? This is flag. So before the flag got formed, we got this pole, and pole is nothing but prior uptrend. It was prior uptrend. So for a flag to happen, we need a very strong prior uptrend, and we say this pole, right? And then the flag pattern happens, and then the after the breakout, the prices goes up, and when the breakout happens, it's an opportunity to buy. And this flag pattern can also occur in downtrend, and this pennant pattern can also occur in downtrend, but we find these patterns more in uptrend. So pennant is very similar to flag, but the difference is that it forms a kind of symmetrical triangle or ascending triangle. That's why we say that it's a pennant, right? So it also has a pole like flag. It also has a pole. I hope this thing is clear to you. Rest all is same. The only difference is triangle, and here parallel lines you can make. Now let's look at one live example of flag pattern. So this is India cement stock, and it is a long-term chart. Now you can see that we got a very strong uptrend, and this is, we call it as pole, right? So we got this pole, very strong uptrend. Then the price started getting consolidated, and it is flag. So when the flag pattern forms, you can see that the volume declines a lot, and when the breakout happens, the volume suddenly spikes, right? The volume suddenly spikes, and then the price starts to go up. So that's how a flag pattern forms. So before resuming the prior uptrend, the prices waits there for a bit, takes a relax, then when the breakout happens, then it jumps. So the analogy of flag pattern is that we need a very strong uptrend. So after a very strong uptrend happen, consolidation is very likely, and the prices are waiting to explode, but they just wait so that retail investors can get out from consolidation, because nobody likes to be there in consolidation. So all the retail investors sell their position at this point, and after the breakout happens, the stock resumes its prior uptrend. So that's how a flag pattern forms, and it is one of the most profitable pattern of technical analysis. So in these patterns you will rarely find pullbacks and throwbacks and so on. So it is highly advisable that you don't wait for pullback or throwback. You just take your position once you get the breakout. I hope this is clear to you. Now let's talk about pennant pattern. So pennant pattern, as we all know, is very similar to flag. The only difference is that in pennant a triangular kind of pattern forms. So here in this case a symmetrical triangle got formed. The prior trend was up, as we all know, and the prices started consolidating. Then after the breakout it went up, and here also you can see that the volume was down whenever the prices were in pennant pattern or in this triangle pattern. I hope this is clear to you. One more thing I would like to tell you about this flag pattern is that you take this pole as your target, right? So whenever you get a breakout and you buy, then you will have to use this pole as your target. So you will measure the height of pole, and that pole height will be your target. And this question can come in your CMT exam. They will give you examples, like they will give you levels at this level the pole got formed, at this level the pole got ended. Now tell me the breakout happened at this level, so now the tell me the target, where to keep our target. So such kind of questions can come, so be ready for that. And that's why I say to practice a lot these patterns, because if you practice these patterns, then only you are going to get good understanding of these patterns. Now I hope these things are clear to you. Now let's talk about the most profitable patterns. So the most profitable bullish patterns are these: descending triangle, declining wedge, head and shoulder pattern, and symmetrical triangle. These all patterns are bullish, right? And when we talk about bearish formation, then diamond top, rising wedge, head and shoulder top, symmetrical triangle, these all patterns are bearish in nature. So how did I come to know whether these patterns are good or not, or better than others? How did I come to know that? Because I came to know because people have done a lot of research on these patterns, and they have back tested its data, and after their back testing they have come to this conclusion. So this data is not just random data, it has been extracted after a very rigorous research which has been done by some people. So as I told you that these things are very subjective in nature, so to understand this thing you will have to practice. And I have some suggestion for you. Whatever patterns I have told you, please practice that once on the charts. Please try drawing these patterns on the chart, because if you don't draw these patterns on the chart, if you don't practice it, then you are not going to learn anything. If somebody tells you these patterns 100 times even, then also you will not understand these things, because you will have to practice on your own to understand these things. And you can read one book on the patterns which I have discussed in this video. If you want to learn more about these patterns, then I have suggested some books to you. So these two books you can read. If you are a beginner, then you can read this first book, which is Getting Started in Chart Patterns, and this book is written by Thomas Bulkowski. The second book is also written by Thomas Bulkowski. So he is someone who has done a lot of research in this long-term bar chart patterns. And the second book, which is Encyclopedia of Chart Patterns, is a very big book and it is a very complex book. So if you want to understand this thing in a very advanced level, then you can read the second book. Otherwise, I would recommend you to read the first book, right? Because it is very simple for a beginner, and for level 1 you need only beginning level knowledge. So you can go with this Getting Started in Chart Patterns book. Now I hope you would have understood all the topics, and now you need to practice all the patterns in order to master these things. And I hope you learned a lot from this video. If you have any questions, you can find us at Instagram. If you want to ask something related to this video, and if you have some doubts, please comment us below, and we would be very happy to answer you. And if you want to ask us any question personally, then you can mail us, you can contact us on Instagram as well, and follow us on YouTube to watch more videos on CMT. Thank you for watching this video. See you next time.